What's up, guys? Here's an in-depth explanation on liquidity sweeps and how to take advantage of them while you're trading. If you're watching this video, there's a good chance that you are currently a trader. Maybe you're experienced or you're brand new, doesn't matter. But whether you trade stocks, options, futures, crypto, whatever, odds are that you've probably heard the term liquidity sweep thrown around at some point or another. I personally only day trade futures, NQ specifically, so I use these sweeps personally in my own trading, but I believe that this concept applies to any tradable asset. So starting with the basics, here's what I like to do before I look for any liquidity sweeps or anything at all. First, I like to mark out my key levels on higher time frames, mainly on the 1 hour and the 15-minute charts. The main levels that I will mark out are previous day's high, previous day's low, as well as any notable pivots in the after hours and pre-market sessions. Some of you might already be familiar with my strategy and what confluences I use, but a big part of my strategy is volume and price action near these key levels. So it's very important to be able to understand what's happening within the candles forming around them. Now, obviously, liquidity sweeps are a very small piece of my overall strategy. So if you're looking for a deeper explanation of the strategy in question, I have a couple videos regarding that on the channel. But this video specifically is going to be focusing on the sweeps. Now, say that price has moved up into a previous resistance, right? Say for this example, this is the previous day's high. So this red line represents a decent key level. Now, before I do anything else, I'll be leaning towards shorting off of this level until proven otherwise. Like my mindset when price is at a key level like this is that the setup is guilty until proven innocent, meaning that unless price breaks above and bases above this key level, I'll be looking to short this because statistically speaking, if price moves into a big level like this, the odds of getting a decent rejection off of that first retest is pretty high. But again, this is just how my brain works personally after doing this for over half a decade. But in my experience and just personally observing price action for several years now, if price is approaching a key level and it hasn't gotten there before, so meaning this is the first retest of that level, the odds of it rejecting off of that same exact level are much higher than it breaking through and making that into a new support. All right, so price is at this level, right? I'll be watching on the 1 minute time frame and looking for a nice 10 to 15 point pop above this level. Once you get that pop above, I'll be waiting for that candle to close back below the key level. Now, as long as I have at least one other confluence to support my bias, whether it's a EMA or a trend channel or volume to support this hypothesis, as long as one of those things match up with the candle close, I'd be taking a short here. Now let me explain my reasoning for why I'm looking for a push above and why 10 to 15 points specifically. So this pop right above that key level is basically where a ton of new longs will be stepping in, meaning that people are buying into a position and betting that the price is going to go higher, right, off of this key level once it's broken through. Because think about it, as soon as people see that price is breaking a key level to the upside, they're going to get FOMO and go long off of that level as well, thinking that it pushes higher, and they're convinced that this previous resistance is now a new support, right? Now, one of two things could happen here. Of course, price could continue to push higher and cook everybody who goes short here. However, statistically, like I mentioned, it's more likely that when price is approaching a key level of previous resistance, at least for the initial retest, the odds of it rejecting are much higher than the odds of it pushing higher. At the end of the day, obviously nobody can predict with 100% accuracy which way price will go. So you have to weigh out the probabilities before you enter any trade, right? But like I said, in my own experience and in my own opinion, first retest, the odds of this breaking and holding this key level to the upside are much smaller than the odds of it rejecting, which means that majority of the time I will be looking to short here instead of going long. But like I said, guilty until proven innocent. Obviously, if the candle behavior near this price level is bullish and it starts to base out here, then I won't be looking to force a short, but for the sake of this example, we're talking about liquidity sweep, so it kind of has to reject. Now, the other scenario is a liquidity sweep happening. So basically, price rips above the level, baits in a ton of new longs who buy along the way, right, above that level. So now they're using this as a new support in their head. So the candle will start to look like this, right? Maybe a wick below, the candle body starts to push higher, and it looks like it's about to close above that previous level, right? Which that would look great. That would be solid confirmation if you are going long or if you are already in a long. That looks great. However, by the time that candle closes, it will look something like this. Now, I'm sure people have heard of the term like hammer candle or inverse hammer, whatever you want to call it, doesn't matter. But basically, the candle body pushed above that level. But however, when it closed, the body itself, it closed below this previous resistance. Now, all those people who went long for the breakout to the upside, they are already underwater, right? Because price is way down here and their average is way up here. So they're already losing money on their positions. Now, just imagine you've been waiting for this price to push above this spot. You finally got the move and you want to join the ride because you think it goes higher, right? So you enter long, but basically right after you're already down and price is actually rejecting off of that level, and you basically realize that you're getting cooked. Now, logically, what are you going to do next? You're either going to get stopped out or sell your position. And at the same exact time, these longs are getting out of their position because of the reject. A whole bunch of new shorts are now piling in because now they think that we're going to reverse instead, right? They see that the breakout failed to the upside. Now they're willing to bet that we reject way back to where we came from. So that's a liquidity sweep in a nutshell. That's more of a technical explanation of what is actually happening. But let me give you a less complicated explanation that I like to use when I explain this to people. So imagine you're on Tinder or whatever dating app the kids use these days. Now imagine you're talking to a smoke show of a guy or girl, whatever your preference is, doesn't really matter. But for the sake of this explanation, say that, I'd assume that majority of my audience is male. So I'm going to go with a female as the person in question. Say that you're talking to this fine young lady on Tinder or Bumble or Hinge, whatever, right? Now think about how excited you are to meet them and, go on trips, meet her family, maybe get a dog, move in together, right? All this fun stuff is going on in your head, right? So you're basically ready to full port on this individual, and now it's finally time to meet her. You pull up to the local Denny's or Starbucks or whatever it might be. You got the flowers, you got a nice bouquet of roses for her, ready for a nice date. You're excited to talk to her, see how she is in person. You think this is going to be a good night for you, you know what I'm saying? But then you realize you walk into the Denny's and you realize that instead of a Miami 9, you realize that she is actually a Mississippi 3, if you're catching my drift. So basically you invest all this time and energy and effort into what could have been, right? Got excited until you find out that it was too good to be true. So obviously you get the heck out of there, you pop in your whip and you're out of there. Just imagine this dude getting out of here, okay? And this individual is actually, maybe she's like sweaty, or she's wearing your least favorite sports team jersey, whatever she's just not looking good, okay? You got catfish, that's the point. So basically you invest all this time and energy and get excited for this, but you got cooked. It was not what you thought it was going to be. So obviously you get out of there, throw away the flowers, drive home and cry. Now it might sound like I'm speaking from personal experience, but I'm not. Now this is just a good analogy, in my opinion, to explain a more complex concept. So anyways, back to the chart. So you got this nice build up, right? You get all excited, flowers, kids, house, dogs, etc. But then it's time for the first date. Bow. You get faked out. This is like peak excitement. And then as soon as you open the door, as soon as she texts you that she's the one sitting in the back and there's no one else, because if the Denny's on a, Tuesday evening, there's nobody else there. So you finally realize that she is the person that you've been talking to all this time on Tinder, and you realize you got catfish. So this is peak excitement, okay? You're happy here, right? Things look good. Things look promising, right? You think that things are finally starting to turn around, and then it hits you. So now you're out of there, okay? This is you. This is price, aka you. This is getting out of that scenario, right? It's a flop. The date flopped, and that is basically what happens on a liquidity sweep and the financial markets as well. Now, this works in either direction. So if you want to apply this to the downside, you can just flip the chart and the lines upside down, and you got a sweep to the downside where sellers will get trapped and then buyers step in and price rips back up off of a key level. Same exact concept, just like I said, just flip this, just inverse this whole thing, and you got your liquidity sweep to the downside. Now, for my system personally, I use a lot of very basic confluences like support and resistance, and I try to take trades where the most amount of people are caught off sides, because that is when the biggest moves happen. So it always helps me to put myself in the other side's shoes, kind of like if you're, a football coach and you're drawing up a play, you want to do exactly what the opposing team is not expecting you to do, right? Because that way you catch them with their pants down, you catch them off sides, you catch them, unprepared, whatever you want to call it. And that is when you get the best opportunities. So I like to kind of apply that mentality to my trading and the setups that I take, and just like to keep it simple. But that pretty much sums up this video on liquidity sweeps. I hope at least one of you guys found this useful. And if you did, then there's a pretty good chance that you like the other videos on this channel as well. I try my best to keep things simple and not waste your time with these explanations. So feel free to check them out if you want. If not, it's okay too, but word to the wise. I also have the link to my Discord below in the description. I'm in there live trading every single day, and there's also a ton of free education there as well. So feel free to check that out. Now, with that being said, thank you so much for watching. Hope this helped once again, and take care.